Polytechnic University of Milan, you may begin.
Science fiction is becoming science facts, and now companies need to embrace technology to survive the market. The digital race is on. Good morning, everybody. I'm Andrea from Politecnico di Milano, and today, with my colleagues, we will present our 44% upside case on Reply, the winning company you must bet on right now. The company is one of the main players in the European IT service industry, and it's going to surf the big wave of digitalization. The digital market is booming. Europe is under unprecedented government push to move forward, but demand is the main driver of this boost. Today, the company priority is sustainability from an economic and an ESG standpoint. Well, digitalization is the answer for both, since it provides sustainable competitive advantage and it's the main facilitator of the ESG transformation. That said, what are companies really looking for? Their investments are focused on digital enablers, advanced technologies like AI and IoT, which enable digital transformation at its best. Their market is forecasted to grow at a stable double-digit CAGR in the next years, and this directly translates into greater demand for IT services, expected to double their growth and reach a market size of 69 billion euros in 2024. Easy money, right? Well, it's not that easy. The industry is a real battlefield. We have big brands like Accenture and Capgemini, but also low-cost players offering commoditized services at a highly competitive price. So, in such a competitive industry, why Reply? Well, because it's no more about the biggest, it's about the fastest, and Reply has a unique ability to anticipate competitors in targeting the most innovative technological niches. Since its foundation in 1996, Reply tells us a story of exponential and outperforming growth, reaching revenues of 1.5 billion spread among Europe and the US. Our investment case is driven by three catalysts: a unique organizational model enabling early adoption, an undervalued human capital, which is the core asset in a people-intensive business, and a mix shift leading to higher profitability. Now, Francesco will present you the network model.
How can Reply be the fastest and anticipate competitors? Actually, Reply is not a single big company. It's a big network of more than 150 small subsidiaries, each of them specialized in a technological niche. The network allows the agility and the flexibility to position on the most promising market niches, winning the race for early adoption. Comparing the last 10 years annual reports of the company with the ones of Accenture and Capgemini, we noticed how Reply adopted every emerging technology at least 1 year before its competitors. The early adoption ensured a sustainable competitive advantage and a best-in-class profitability, with an EBIT margin of 14%. To stay on top of innovation in such a dynamic industry, the network model needs to constantly evolve. Reply's growth strategy is based on bolt-on acquisitions, which provide an average 2.3% contribution to the top-line growth. Now, it's a people-intensive industry, so let's talk about people. We believe investors are underestimating the core asset of the company, its workforce. But how can we state this? To assess the human capital value of a company, we developed a proprietary framework that estimates the value generated by each worker, starting from its capitalized cost. Reply has the highest value per employee among its peers, but what are investors getting from this? Well, high human capital means high value generation capability, and Reply stands out for its high profitability, more than twice the industry average. Reply also demonstrates a superior capability to leverage its workforce, with a 5.6% return on human capital. The company differentiates from its peers thanks to its exclusively onshore hiring policy, which has a positive social impact, fostering local employment. This policy, aimed to secure the best talents in the market, will allow Reply to focus on high value-added services, further improving the value added per employee. This, combined with a larger employee base, will result in a substantial expansion of the operating profit. Now Alberto will guide you through the third catalyst and the valuation.
Some of you might associate Reply, a player in the IT service industry, with the traditional and not so appealing system integration. Well, forget it. We reclassify the total revenue of the company with the bottom-up approach based on each subsidiary's financial statement and their website. And what we discovered is actually impressive. While most of its peers still have the majority of their business coming from standard software implementation, Reply's business portfolio is undergoing a mix shift toward digital enablers. We called Advanced Technological Solution the segment including subsidiaries which design innovative solutions based on these technologies, already representing Reply's core business. Reply is increasingly focusing on this segment to capitalize on the mass expansion of digital enablers, which will account for 60% of total revenues in 5 years. The increase in profitability will be backed by the international expansion. The highly profitable American market, with a size of $136 billion, offers tremendous opportunities for the company. The US, where Reply entered in 2018 with Valorem's acquisition, currently represents the main focus of the M&A campaign. As such, we forecast a 14% exposure to this market by 2026. At that time, we expect the operating margin to reach 14.5%. Now, let's see how these three drivers impact our valuation, an equal blend of discount cash flow model and relative valuation, leading to a year-end target price of €180 per share. The first stage of the DCF accounts for a 5 year of strong growth, surfing the big wave of digital enablers and relying on a 3.6% of inorganic growth. This, combined with the profitability improvement, will boost the cash generation of the company, with net cash expected to overcome $600 million in 5 years. After a normalization period, the terminal value is being computed with the perpetual growth rate of 3.15% and the discount rate of 6.82%. The result is a target price of €182 per share, which proves its robustness to the main valuation risks. What about relative valuation? Let's discuss it with Alessandro.
Our multiple analysis is based on our proprietary model, identifying EV on human capital as the most appropriate multiple to compare Reply with 7 IT service peers. We obtain a 42% upside, given by a 1.5 year end target multiple. This multiple, even backed by traditional ones, positions the company between two clusters. The full digital player, completely focused on digital technologies, and the diversified ones, which also provide commoditized services and traditional consulting activities. Despite the growing similarity with the full digital player, Reply still trades at 29% discount. Therefore, we expect a potential repricing of the stock, considering it should trade at multiples aligned with this top-tier cluster. Coming to ESG assessment, Reply's sustainable performances showed a substantial improvement over the last 3 years, moving from a double B in 2018 to a single A in 2020, filling the gap with the industry average. On the environmental side, Reply operates in a low carbon-intensive industry and represents an eco-friendly investment thanks to its relevant impact on Scope 4 emissions. Moving to the social pillar, the company stands out for its focus on hiring young graduates, which represent around 65% of total hirings in 2020. Moreover, Reply strategically hires exclusively onshore personnel, fostering local employment. Governance is the biggest company weakness. Our main concerns are related to insider ownership, with the decisional power in the hands of the Rizzante family. Besides, we show a red flag on the poor disclosure policy adopted by the management. Now, I leave the floor to Gianluca for further considerations.
Let's now take a look at what potential investors may ask. The first key question is, how would the company handle any M&A risk? This risk is certainly concerning, especially after Portal Tech. This British company was acquired by the group, and then its revenue went down by more than a half. This apart, the company has a long history of successful acquisitions. Management has now improved the scouting process, stressing the synergies of the network model, and continue to avoid transformational deals. So, when they took over Valorem in the US, its revenue doubled and the EBIT margin almost tripled in 3 short years. In addition, should you be worried about the downward trend in the stock price since the start of 2022? The answer is most definitely no. This trend is determined by purely exogenous events. First, there was the rise in real long-term interest rates, which does not influence the EPS growth prospects, but affects the discount rate. The second event is the uncertainty caused by the Ukraine crisis, which we know is affecting the global market. That said, it has no impact on the company's intrinsic value, backed by the resilience of the IT industry, which has always reacted to periods of demand slowdown. More than react, rebound. Just look at COVID-19. We will put our neck out and not see them as a real threat, but rather as the opportunity for a good entry point. To conclude, we will restate our buy recommendation on Reply with a 44% upside and a near target price of €180 per share. The digital wave is coming. Get ready to surf. Thank you for the attention, and now the floor is open for questions.
Thank you for your presentation. May you please provide some color on how you model the top line growth, margins, and how the service mix shift affects the evolution of those margins, please?
Yeah, sure. Starting from the top line growth, in our first stage of the CF, the top line growth, the organic top line growth is about 10.8%, and it's the result of a correlation between the organic growth of Reply and the growth of the underlying market of digital enablers. Since in this market, given that Reply is not a developer but is a service provider, its revenue benefit most when the technology reach the mass expansion. And we are really dealing with years in which many technologies like artificial intelligence and IoT and many other are now really ready to reach the mass expansion, and the result is this impressive 10.8 organic growth for Reply. Then for what concerns the inorganic growth, there is this contribution of the M&A, which is around 3.6%, which has always been part of the total organic growth, on the total top line growth. And then talking about the margins, our mix shift is one of the key drivers behind the evolution on the EBIT margin. And to better understand where does this mix shift came from, we have to start from the reclassification of the portfolio of Reply that we provide in our analysis, thanks to our analysis of the shareholders meetings in which the company disclosure each subsidiary's financial statement, and we went for more than 150 subsidiaries, reclassifying them in these 4 business lines, so namely software implementation, the ones related to the implementation of SAP, Microsoft, Oracle, and advanced technological solution as the main 2 ones. For what concerns advanced technological solution, we are dealing with subsidiaries which design innovative solutions based on artificial intelligence, cloud computing, and all these other digital enablers. What we understood through this reclassification is that there is this segment of advanced technological solution which is both the highest profitable with an 18% EBIT margin, but also the fastest growing segment for the company. And so projecting this pace of different growth for the future years, we aim to identify that the overall exposure of the company to this digital enabler sector is going to increase. And more specifically, we talk about 60% exposure by 2026. So the overall contribution on the EBIT margin is going to be that the EBIT margin will increase at a level of 14.5% in 2026.
Well, is the growth that you are projecting incorporated in a 30 times P multiple? How cheap is the company if the technological sector is suffering from a rising interest rate environment?
It is true that the actual tech environment is suffering from the rise of interest rates. As a matter of fact, as we can see here in the slide, we are speaking about a 90% correlation with the Reply share performance with respect to the Nasdaq index, which we took as a sort of benchmark for assessing the value of the tech market. It should be noticed, however, that, as you currently mentioned, we are dealing with an increasing trend in terms of interest rates, which is even backed by a macroeconomic scenario, which is for sure uncertain. And this will lead the company to suffer in the short term from this uncertainty given by these 2 macroeconomic events that will for sure impact the market in the short term. However, it should be noticed that Reply has very strong fundamentals, as even confirmed by our projection in terms of EPS, and we are dealing about 60% in the last 5 years, which is even projected for the coming 5 years more. And so, and this is even confirmed by the latest release of the company, which occurred about 1 hour ago in terms of the first quarter, and we are speaking about 25% of top line growth, which is a value far above the value of and the result of the last quarters, where the top line growth was about 14%. So we are dealing with the company with a flourish future that is capable through its network model to serve all the emerging technologies that the company will even develop in the coming years. And so we are not worried about the downward trend of the stock price in the last years.
In addition, we want to underline that Actually, this moment is just a good entry point to buy the stock. Indeed, also in the past, Reply suffered from exogenous events, as we can see from the slide, with huge downside in its stock price. However, as my colleague said, Reply has strong fundamentals, and thanks to its strong fundamentals, has been able to recover from the losses in just 1 month. Moreover, in 6 months, as we can see from the slide, the company is able to reach huge upside, as in the case of the rising of interest rates in 2018, with a 38% upside in 6 months.
Can you speak about your return on human capital a little bit more? What is the denominator there? How is that measured? And then secondly, how do higher wage inflation, how does that impact that particular
Well,
measure?
First of all, we need to start from the reason why we chose to adopt the human capital model, which is because this is a people-intensive business, so people play a critical role in the value creation process. And with our model, we wanted to capture the intangible value that people provide to companies in the IT service industry. To compute this model, we started from the geographical reclassification and the competencies of the employees, and we obtained the human capital value, which is the value that people can provide to both Reply and its customers, because having onshore people like Reply does increases the value for the customer, because Reply operates mainly in Europe and the US and has most of its customers located in this region. So having an employee base which is close to the customers adds a lot of value, both in terms of language and in terms of time for example. And so this is our cost-based approach, because the human capital value is a cost-based approach that has also implication on the profitability side. In fact, as we can see in the slide, Reply has the highest value per employee among its peers, and this directly translates into the highest EBIT per employee, which has a value of around 20,000 euros and is more than double with respect to the industry average, which has a value of around 9,000 euros per employee.
In addition, we also introduced an innovative metric, such as the return on human capital, to, let's say, take into account the strategy, because an investor might think that the offshore policy will lead to higher returns, higher profitability, but that's not the case. Indeed, we can see that Reply, with its onshore policy, has the best return on human capital, 110 basis points more than the industry average, showing so that with its onshore policy, Reply is able to capitalize its workforce and to create value.
Concluding with wage inflation, which is for sure one of the hottest topics at the moment, we need to notice that Reply is actually influenced by inflation, mainly through wage inflation, since we are dealing a cost structure which is 80% exposed to cost of personnel. As you can see here in the slide, Reply has already dealt with wage inflation in the last 10 years, passing from a cost per employee close to 65,000 euros to about 75 in 2020. However, in the IT service industry, companies tend to revert the impact of inflation on customers. And so, as you can see on the slide on the right about the revenue per employee, Reply has, in the last 10 years, a constantly increasing revenue per employee, thus testifying not only the mix shift that the company is currently undertaking, but even this phenomenon of reverting back the impact of inflation on customers. Therefore, we are not worried about the impact of inflation on the profitability of the company.
And specifically, Reply here has two advantages. One is related to the cost. As we can see here in the wage inflation chart at the right, the company mainly operates for a measured part in Italy, which has a rigid labor law, and so the impacts of wage inflation are low. And regarding the revenue, the company operates with short-term contracts, which are around 1 year of length. And these allow the company, as my colleague was saying, to revert more fast than competitors these costs on the price side.
A lot about IT projects is surrounds speed. So what is the average project implementation speed vis-a-vis their competitors out there?
Sorry, could you please repeat your question?
So have you looked at how fast or what's the period of implementation, IT project implementation speed versus the competitors like Capgemini and the large MNCs that you have shown as their competitors?
Yeah, companies like Accenture and Capgemini operate generally with a longer term project because they have a significant portion of their business coming from activities like, for example, business process outsourcing, which represent recurring revenues and therefore require higher, longer term projects. However, this leads to lower profitability performances because the services which Replies focuses on provide higher EBIT margins, like the ones that we mentioned before with the software, with the advanced technological solutions, while low value-added activities like the ones, for example, of Accenture and Capgemini are less profitable than the ones that Reply focuses on.
Sorry, so what's their cash cycle versus the competitors? Do you have it?
Yes, for what concerns the cash flows of the company, and the company is currently outperforming its competitors in terms of cash performances. You can see here a significant in growing in the free cash flow of the company, also thanks to good management of the working capital over the last years, and particularly we are talking about the reduction in the DSO of the company. We can also show you an analysis which sees the free cash flow performances of the company compared to the Euro stocks companies. And if we go to these slides, we can appreciate that the company is really one of a kind company in terms of cash performances. If we consider metrics such as the level of debt and the sales CAGR of these companies, and the downside months, the revaluation in the free cash flow of the company, and lastly the growing of the last 10 years in terms of free cash flow, we really obtain a limited top tier class which Reply joins. So again, also from this point of view, representing a one of a kind company even compared to the European stocks.
A question about
what are your
ESG?
thoughts on
Sorry.
on the Area 42 Development Center for investment in robotics, blockchain, the metaverse? Is this the future of the company, or they have to stick to solutions like the quantum inspired algorithms and the things that they are already giving to the market?
Yeah, sorry. Yes, that's a really crucial point for the strategic positioning of the company. If we can go back to the slide of the service portfolio, we can see that the company really focuses on the advanced technological solution segment, which comprises all the solutions based on cutting-edge technologies regarding of the period when we are. Right now, these cutting-edge technologies are cloud computing, IoT, artificial intelligence, especially autonomies of things. And this allows the company to provide services which are really on the edge of technology and profit with an 18% EBIT margin. So you mentioned technologies that are really on the edge of reaching the mass expansion. And so the company is really focusing also on that, also on blockchain, and also on the quantum computing, yes. And still, this is about the fast. Right now, the company is really fast by targeting niches that allows them to focus on continuously new technologies and provide the solutions that the competitors does not at the moment.
Focusing on quantum computing, for instance, the company in the last month developed